Today, we're diving into an analyst report that sees some absolutely huge potential in a tiny company that, well, almost no one is talking about.
So here's the big question we're tackling. We're going to break down this report on a company called WATR Intelligence to figure that out. It's a classic Wall Street story. Is there some kind of hidden value here that nobody sees? Or is the market right to be so cautious?
Okay, first, let's just set up the puzzle itself. The story kicks off with a company that's profitable, it's growing, but for some reason, the market just doesn't seem to care.
Now, this company, its ticker is WATR. It isn't some speculative startup. Okay, it's a really established player in a super critical industry, and they've been consistently growing their sales and profits for years. But here's where it gets really weird. The valuation. I mean, look at this gap. Based on what analysts expect them to earn in 2026, WATR Intelligence trades at a price-to-earnings ratio of just under 10. Its competitors? Well, on average, they trade for nearly 25. That is a massive discount. And just to put its size into perspective, this is a tiny company in the grand scheme of things. It's valued at only $60 million as of the time of this report. So the question is, what's going on here? Is this a bargain, or is it a bust? All right, to solve this puzzle, first, we've got to understand what WATR Intelligence actually does. So the bulk of their business, their crown jewel really, operates under the brand American Leak Detection, or ALD. Just think of them as high-tech water detectives, pretty much for the entire country. And you can see here from the analysts' 2025 forecasts, their business is just overwhelmingly based in the United States. This isn't some sprawling global conglomerate. Nope, this is a very focused American story. And we're not talking about your average plumber who just shows up with a wrench. These guys use some seriously specialized tech, like infrared and acoustics, to find hidden leaks without having to smash down your walls or dig up your whole yard. And their client list is huge, everyone from regular homeowners to the biggest insurance companies in the country. So why does all this matter? Well, get this, $13 billion. That is the annual cost of water damage insurance claims in the U.S. alone. It's a massive, persistent, and incredibly expensive problem that ALD is perfectly positioned to solve. Okay, so let's recap. We've got a profitable market leader in a huge industry that's valued on the cheap. This analyst report argues the market is completely missing the boat on the company's three-part growth plan. The company calls this its Next 50 strategy. Pretty cool name since ALD is just entering its 51st year. And the analyst believes these three streams could fundamentally transform the whole business. And, of course, its valuation. First up, we have the Dallas template. And this is a brilliant example of the potential here. So the company bought a super profitable franchise in Dallas. And by adopting their leaner, incentive-based pay model, the report says the corporate-owned stores could slash labor costs from 40% of sales all the way down to 25%. I mean, that flows directly to the bottom line. Second is a huge strategic shift in their entire business model. And this is all made possible because of a partnership with a company called StreamLabs, which is a smart water monitoring platform owned by the insurance giant Chubb. Now, this is a really crucial point. This shift could change their business from just getting one-off emergency calls to having a predictable, subscription-based service. So instead of waiting for a disaster, they can monitor water flow in real time and fix tiny issues before they become catastrophic, multi-thousand-dollar claims. And finally, they're planning to stick with their proven strategy of smart acquisitions. They've been successfully buying back their own franchises at really good prices, which is just a straightforward way to add profitable revenue right back to the parent company. So let's bring it all together. What happens when you combine this profitable but cheaply valued business with this whole Next 50 growth plan? Well, according to this specific analyst report, the valuation puzzle doesn't just get solved, it gets blown wide open. From a price of 310 pence when the report was written, they set a 12-month price target of 500 pence, and long-term, a potential of over 900 pence if the strategy really works out. Just to put that in perspective, in the analyst's main scenario, we're talking about a potential upside of over 60% in the next 12 months alone. That is a significant re-rating from where the stock is today. And here's the core of the whole argument right here. The market is looking in the rearview mirror, pricing the company as it is today. The analyst, though, is looking at the roadmap ahead and seeing a far more profitable company come in 2025 and beyond. And this leaves us with the big question at the heart of this report. The classic tension in investing. Who is right?
Is it the collective wisdom of the market, or is it the deep dive analysis of one expert?
And figuring that out is what makes investing both a challenge and, of course, a huge opportunity. Thanks for digging into this with me.